Until now, people and collapsing banks and companies in the US have been benefiting from the lowest interest rates and the ability to secure loans easily. Unlike any other country, they could buy anything they liked and pay later, since the interest rates were quite low. In turn, this was because of the ease with which the US would print money, creating inflation that could be exported out of the country. Since the US dollar had international reserve status, instead of creating disastrous inflation, the extra printed dollars were paid for by the goods and services imported into the US, thus maintaining a delicate balance. Put simply, the US leveraged its status as the financial order giver, while the world struggled with a zero-sum game, where one side is predestined to lose every time. But what if we say that this is going to change radically, and the system that gave the US leverage is going to collapse? Well, Howard Marks, the billionaire legendary investor and market analyst, not we, are saying this. He has said that the third sea change is around the corner, which will bring catastrophic changes for the US. In this video, we'll explain everything you need to know about a sharp turning point for the US economy, which Howard Marks has talked about in his memo.
All right, Oaktree Capital Group co-chair Howard Marks really needs no introduction. More than 50 years of experience with a very unique and evolving assessment of what constitutes value. His periodic memos, must-reads.
We're no longer in an easy money environment. If it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been.
Here's a reminder to please like the video and subscribe, as it helps the YouTube algorithm to push our videos to you. Let's get started. If you don't know who Howard Marks is, he's a legendary billionaire American investor, author, and one of the co-founders of Oaktree Capital Management. The reason why he has deep insights into turbulent market conditions is because of this management firm, which focuses on investing by creating a hedge against distressed market crises. Due to his books and memos, written for investors worldwide, Marks has earned a strong reputation for his insightful investment philosophy. Well, he is the guy who knows what to do when things are going out of hand in the financial market. That's why his world-famous memos are widely read and provide insights into investment strategies, market dynamics, and economic forecasts. In his memos and books, Marks has often used the term sea change, a philosophy he developed. Put simply, sea change means a profound yet dramatic shift within the investment and financial world which people should prepare for. Back in December 2022, he'd written a memo named Sea Change, while recently, on October 11th of this year, he released another memo called Further Thoughts on Sea Change. It's this memo which has created some shockwaves. Marks argues that the financial markets are experiencing a sea change, ending the accommodative central bank monetary policy. In other words, earlier, the government will no longer bankroll collapsing banks and companies by offering loans at low interest rates. This is an unorthodox change, something nobody was expecting. But what more does the memo talk about? Some of the things Marks says in his memo are scary for the majority of people, up to the point that it seems hard to believe in. Earlier, the US witnessed the lowest interest rates and abundant liquidity. Therefore, borrowing money was more accessible, and financial conditions became favorable for businesses and investors to thrive. Easy money was driving the US economy, allowing Americans to lift their standards of living without worrying about money. At that time, the infamous policy of buy now, pay later was the norm, where Americans could afford everything, but by relying on debts. Now, we're not talking about the distant past, but of today, where most Americans use credit cards for daily payments. That's why in the second quarter, the US credit card debt crossed the $1 trillion mark, increasing by $45 billion in just 3 months. However, Marks says this favorable environment will soon be over. It's because this easy money era led to inflation in asset prices, creating a highly stressed period in the investment market. Understanding this point is crucial because earlier we told you that the US exported this inflation. Well, it's right. However, when this extra printed money was used to invest in various assets, the demand for those assets increased. Naturally, their prices increased and this inflation could not be exported. Marks argues that this asset price inflation can raise concerns about potential bubbles in the market. Meanwhile, the low interest rate environment has encouraged borrowing, resulting in high debt levels across various sectors. That's why the U.S. household debt crossed $17 trillion just recently. To bring this back to normal, Marx says that we'll need to see a sea change, which means higher interest rates. This will not only make borrowing in the future expensive, but also increase the rates on already taken loans. That's when things will get nasty. Even if households could refinance their loans despite increasing interest rates, businesses would be the ones to be badly affected, since they take debts from millions to billions of dollars. A minor increase in interest rates can bring We know that Silicon Valley Bank and Signature Bank already collapsed, partly due to high interest rates. Increasing interest rates were the reason why the U.S. reached the 2008 financial crisis. During the housing bubble, numerous homeowners and businesses capitalized on the opportunity of low interest rates to accumulate debts. However, as interest rates began to rise, many encountered obstacles when attempting to refinance their mortgages, ultimately resulting in foreclosures and widespread financial crises. Now, as interest rates are on the rise, Marx argues that more companies will default on their loans. Not only will it create a huge hole in the economy due to their collapse, but the non-performing loans will also vanish, bringing turmoil we have never seen before. Even the government itself won't be exempted from the sea change. It has to issue new debt, despite having no liquidity, forcing it to print more money. However, Marx argues that this time, the government has to ensure that it offers debts at higher interest rates to retire maturing obligations. Since the government will be offering loans despite having huge holes in the economy, this might cause a temporary standstill in the government's welfare programs. Not only that, but the government itself has to refinance its debts at high interest rates, creating budget deficits. We saw this in the 1980s when the United States grappled with escalating interest rates. The government had to refinance its debt at elevated rates, resulting in expanded budget deficits and heightened levels of government debt. Dollar devaluation becomes yet another issue the government has to deal with. Since the government will print more money, the dollar's value will decline sharply. In turn, this will increase the U.S. national debt, bringing the debate to Congress to decide the debt ceiling. Marx argues that there's already uncertainty about the government's long-term financial outlook. This uncertainty will make it more difficult for the government to manage the situation, as investors will not invest in long-term treasury bonds. It'll be a cycle where one wrong step will trigger a chain of disasters. Because Marx issues his memo before things go wrong, investors have the time to prepare for what's coming. Marx says that the only tool that's valuable in these conditions is investors' rationality about the market. In his recent memo, he is seen continuously talking about avoiding attempts to predict the future, as he says it's nearly impossible. A better option, he argues, is to use all the available insights and data about the market. Instead of engaging in wishful thinking, investors have to be rational and pay attention to the changing market landscape. Therefore, as interest rates are going to increase further, Marx feels it's rational to invest in the credit market. He argues that it'll bring less uncertain returns than any other sector at present. But what do you think? Can the U.S. get rid of this inevitable change that has been brewing for decades? If you like this video, give it a like and subscribe for more videos. If you want to know more about geopolitics, you can check out more videos on our channel.